Hey, Mike, can you hear me?
I can. Can you hear me?
I can hear you.
Perfect. I have my little mute on. Uh, how's it going?
I'm good. I'm good. Yeah, just kind of, the dog days of summer here.
Right. We had some little housing starts today. Fun stuff.
Yeah, there's, outside of the completions and homes under construction, um, when you look at the actual starts, actual permits, there's really no putting lipstick on the pig. The single family component, everything is definitely trending in the wrong direction here.
Yes. I mean, I've got a little different spin on it, but I think, well, we can get into that.
Yeah, no, and I think, again, I like the completions aspect of it, and then we'll see with the pullback here in interest rates, and like kind of signs that inflationary pressures are starting to ease a little bit. Does that kind of give you kind of a middle to end of summer type kind of pushback for demand? Well, we'll see. To be determined, I guess.
Yeah, yeah, yeah. I think, I just look at some of these headlines and journalists love to make a splash.
Well, I think they're, again, going back to the CFTC commitment of trader numbers, I think they're definitely, when every headline is negative surrounding housing, they've definitely been influential. As much as I don't want to say commodity funds are influenced by headline, kind of media driven type numbers and headlines, you certainly can make that case.
Well, I would argue that the hedge funds are about a month ahead of the media.
Yeah, 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 yeah. No, I agree there.
For sure. Oh, hey, it's noon already. Let's. I'm just gonna
Yeah.
figure out how many people are watching this quickly. There we go, live. All right, let's kick this thing off. It's summertime, and got Greg Kuda with me from Westline Capital. Um, what's happening, Greg Kuda? Let's talk.
Well, obviously, we're a week into the new mini contract, and it's been sluggish to say the least.
Yes.
Here's so this is from the CME Daily Bulletin this morning. The new September mini futures contract has 30 open interest, up 7 yesterday. November has 34, up 1. So total open interest 64, up 8. And then, these are the quotes on one of my, this is from a CQG driven quote system. I think that, the one thing I'll say is I'm not going to get overly bearish and harp on all this, and that there are always growing pains associated with an implementation of a new contract, especially when an existing contract already exists. And you're just having significant IT infrastructure build out problems where a lot of quote vendors still can't access like this I know you see it on your TT machine, Mike, but this
Correct.
is the conversion spread. If I want to place this conversion spread, I have to call it in to my back office. I can't place it on either of my platforms right now, and the timeline on this is frustratingly slow. We were told by the end of the week, and it's still an issue. So again, in the grand scheme of things, when we look back on all this will all be corrected. You'll have 100% inclusion as far as all trade platforms, all traders, the ability to trade this. But I still suspect that quite a few traders can't access. If they can access the outrights, great, but they can't access this conversion spread, and they can't access the mini spreads here, the SEP Nov, Nov Jan, Jan March, and that'll just take a little bit longer than we would have liked, but that ultimately will happen. And the one thing I'll stress to everybody out there is that this is not going to be optional. This will be the new contract as we move
Yeah.
along. So the idea that I know this industry doesn't like change, but this is what's going to be, and it's just going to take a couple of large traders to embrace this. And then once you do that, I suspect once you get September off the board, you're going to see a lot of infusion into this mini contract with November into January. But I think everybody's fixated on September and cleaning up September in the big contract first, and then kind of shifting gears into the mini contract.
I think you're 100% correct on that. And look, if it's not easy to make the roll from the old to the new because the automated spread's not up there, why would you do it? There's no incentive.
Yeah. I know that there are market makers out there, looking for the volume traders, looking for the volume blocks. That they're very receptive, and it's just, again, and speaking to people that have kind of market makers with new contracts, this isn't very abnormal. Unfortunately, it's very normal that it just takes time to kind of get all this in place. As much as you like to have everything in place, with that actual kickoff date, it's easier said than done from a technology standpoint. So it will happen. So, again, I think get September off, and then we'll kind of see the open interest start to grow pretty dramatically thereafter.
I think you're right. I think you're right as well. So let's jump into it, and then we'll start talking about that spread between the old and the new, and make that a regular feature here.
Yeah, definitely. So we'll kind of start big picture and then work our way into housing and lumber. The big things that jump out to me week over week is you had, I'll pull this up first, then we'll come back.
Do you want
We
to
had,
make that full screen, that thing?
oh yeah, I'm sorry. Let me do it this way. There we go.
Perfect. Thank you.
So last Tuesday, Wednesday, we had CPI, PPI. The numbers were both lower than forecast. So the market got all excited that inflation's under control. We're done going higher. The Fed is, through their interest rate hikes, is controlling inflation. And going back here, you could see the yellow line is the S&P, blue line is the NASDAQ, green line is the Dow. We've had pretty significant rallies to where now the S&P, here's an S&P daily, here's the all-time high, here's the secondary high. So the S&P is back to this 62%, grinding up to 62% retracement. You're back almost up into the 200-day moving average. So the market's come a long way in a relatively short amount of time since the beginning of July, July 4th, where we've just, we did it. Inflation's under control. I think the market's expectation is that the Fed is going to do a rate hike in August here and then move to the sidelines. And the markets are exuberant, to say the least. That the markets are the markets, the economy is the economy. What does one have to do with the other? And when you look at the markets here, they're betting on the fact that inflation's under control, that we're going to either not have a recession or go into a very minor recession, in that money sitting on the sideline is a lost opportunity cost. So you've seen this big inflow. That's the big difference on this rally here, is you're starting to see an infusion of outside money starting to chase equities higher. So going back to, here, the other big kind of catalyst to see this infusion in equities is interest rates stabilizing. We really haven't done much in the way of the 10-year and the 30-year. We continue to trend sideways to seeing slight improvements in those. And then also crude oil. Crude oil continues to trend down, which is a big beneficiary for equities. Sticker shock at the pump, putting money back in people's pockets, that kind of stuff. So when you look at, the other big thing I'll point out here is you can see the US dollar has at least had a temporary bottom and started to trend higher. And this almost coincides perfectly with crude oil topping out here on this recovery rally and resuming its downtrend. This is gold, wheat, copper. You could see how really they're just following the US dollar right now. whereas the dollar bottoms out, you get these topping out in commodities. And so now we'll see if we can get a 50, 62% plus retracement in the dollar. You would get that correspondingly. Crude oil is on the precipice of taking out its lows. Unleaded gas, heating oil took out its lows. Crude oil never took out its recent low. So we'll see if that's the trend here. But lumber, um, kind of going into, you know,
Let me make comment just on big
yep,
picture here. Something that wasn't talked about that much because it wasn't that exciting this last week. China did a rate cut.
yep,
I mean, the second largest economy in the world did a rate cut, and all we can talk about is inflation. And um, I think that what's overlooked here is we're coming from such a low point of interest rates that they're really getting more to a normalized state. The thing
yeah,
that we Americans or the Western world, I guess, we're impatient. We don't like time. We don't like to wait for things to fix or work themselves out. And this thing's going to take a little bit of time.
yeah. That sounds
Um,
like my kids. Instant gratification, right?
yeah.
Why wait for that satisfaction when you can get instant gratification?
When you think we shot the
Um,
fire hose at this thing at the beginning of the pandemic, we shot just money at it, where China just shut down. Like it was two
yeah,
different approaches to the pandemic, and you're seeing the different results from them. Opposite ends of the spectrum. We're raising rates; they're cutting rates. Um, I think that the overall slowdown is really going to be generally good because we stressed our supply chain to the point where it was the best cure for higher prices is higher prices. When your chart you go from $5,000 to ship a container across the ocean to $25,000, when the cost to ship the container is costs more than the goods inside the container, things are obviously going to be out of whack.
yeah. Yeah, the other thing, what's interesting in kind of watching all this aggregate stuff is equities, are building in the belief that, okay, it's going to be a very minor temporary recession. But then when you look at overall commodities here, especially crude oil, it seems to be more triggered off of the global headlines, especially with China this past week, where Sunday night they had their factory orders, they had their version of kind of industrial growth, both missed, and you had a big sell-off in China, and in turn you had a big sell-off in energies, where kind of commodities kind of want to fixate on the global impact on demand, whereas our equity markets are not fixated on that at all. That they're just more, we did it. The Fed is in control or regaining control. So it's interesting to see this kind of shift where they were all influencing very influential and trending in the same direction. Now you've kind of had this disconnect. The one thing I'll say with crude oil, and especially the unleaded gas, is that now you start to shift from a production standpoint into anticipation of going into winter. So you get different blends, more expensive blends. You start to get the anticipation of heating oil demand. So seasonally, it'll be interesting to see if energies, specifically when you crack a barrel of crude, you get the byproduct is unleaded gas and heating oil. If I'm looking for those markets to bottom out first, and then crude to get dragged up. But I think you would see that bottom first in unleaded gas, and then the crude complex start to trend higher. But we'll see. We'll see. Uh, so kind of last 5 days here, obviously lumber has had a pretty substantial rally. Um, you're starting to see heating oil. And again, this was as of this morning. The energies are down a little bit right now. And then obviously you got the NASDAQ, the Russell, you've got the Dow futures, the mini S&P. You've had some pretty big gains in equities here over the last week off of the positive CPI, PPI news. Um, you know, Losers here, volatility. Life is good. S&P is trending higher again. So VIX is kind of building out the idea that there's going to be volatility to the downside now.
or
Um,
lower volatility.
yeah, I'm sorry, lower volatility because we're just, we're back in this uptrending life is good scenario with equities. And then obviously the energy markets here kind of struggling with, do we fixate on our positive metrics here in the States, or do we look at the global ramifications of China? And I think energies kind of are more skewed toward Chinese and global growth than anything domestic right now. We talked about CPI, so kind of getting into the housing complex now. So when you look at housing inflation, you had a nice downtrend with the last CPI reading, where housing CPI actually had a big, where's it at here? It's the lowest month over month change since August of last year. So that's you stop that trend of going higher here. You're starting to trend down now with housing inflation, which is a positive thing. And this is again more so less to do with home price appreciation, more so to do with building materials, the things that go into building homes. And then here is 30-year mortgage rates versus kind of the big outlier years. And you can see from an interest rate standpoint trending higher. This is still following 1981 here. So yeah, we've come off the highs, but relatively speaking, when you look at kind of the net change from the beginning of the year, this is still the second highest year on record as far as that net gain in interest rates still being high. Even though we've come from low money, free money environment, we're still on a percent change basis year to date, still relatively high versus all previous years here.
Yep.
So we talked about. I thought this was a great chart. As oil price red, mortgage rates blue. So you could see as oil prices start to come down, mortgage rates start to come down. It's an interesting correlation here. And then we get into yesterday, we had home builder sentiment. And then today we had housing starts. We'll just run through this quickly and then jump into lumber. But obviously the headline number yesterday was pretty disappointing, where you had one of the biggest here, the lowest level since 2014. I think we were we were 49% on home builder sentiment. And then today we had housing starts, and they had building permits 1.67. And again, these are seasonally adjusted. Housing starts at 1.446. Housing completions up 1.1424. So this is a big number. And I know we've talked about this in the past, Mike, and that how we had this divergence between permit starts and completions. Well, now you're starting to get the convergence where completions are trending higher, and obviously permits and starts are starting to trend lower here.
There's without a doubt, there's a catch up happening where,
yeah.
Going back to my supply chain comment, the supply chain's starting to fix itself. These guys are like, I got to get this home done or these homes done. It's more important to get homes done at this point than get something new started.
Yeah, so I'm a big fan of the actual numbers more so than the seasonally adjusted. I'd rather do my own interpretation of the statistics than having a seasonal adjusted interpretation for me. So I look at the actuals, and when you look at the housing report from the USDA, it's not seasonally adjusted. I'm sorry, not USDA, the Commerce Department. So when you look at July, here's United States total. This is total permits. So you could see a big drop month over month. And we're at the lowest level now with building permits. So November of last year. And then when you break it out, 1 unit is your single family, 5 or more units is your multifamily. You can see single family had a pretty big drop month over month. And then when you look at single family, you're at your lowest growth metric now in 2 years. That's the big headline number there, is that single family is growing at its slowest pace now in the last 2 years. So basically you're going back to kind of pre-pandemic type levels. The multifamily component, which is highly volatile on a month-to-month basis, down month over month. Um, you know, and you can see still up though year over year. So again, this is where the growth is likely to come from, the multifamily component. And then when you fast forward, this is actual starts, housing starts here. You can see in July, month over month, a big drop in the total starts. Again, you're back at kind of levels you haven't seen since November, December of last year. And again, this is when you seasonally slow down anyway. And then when you break it out into single and multifamily, you can see again this single family component is back to December lows. And then when you look at the multifamily component, kind of it's tough to get excited about the actual numbers when it comes to both starts and permits. This is the negative part of the housing starts report. The positive part is here is, and I didn't label these, and I apologize. These are homes. These are. This is homes under. I'm sorry. This is houses completed. You could see we continue to trend in the right direction here. Highest level this year and last year, which is highly positive. Where you're starting to obviously catch up now from a backlog standpoint. And then these are homes under construction. Same kind of thing. Highest level. You got to go back to December of last year, but trending in the right direction. And so now we can jump into lumber. Weekly continuation chart. We're just kind of hovering around this upsloping trend line. In an ideal situation, you would go back and fill this July expiration gap. We'll see how realistic that is. Fast forward into September. Um, the market did have a 62% rally last week. Now we're pulling back. My guess is if this market's going to hold and you're going to have an attempt to kind of make higher highs here, you're going to hold this 9-day moving average. You would conceivably, this is 573, this bar low. This gap close here is a 565. So really the market would hold somewhere in a 38 to 50% retracement to the downside. Technically, you would hold here and then bounce and try to go reattack the recent highs from last week in September. Um, as far as my interpretation here, genuinely does futures belong at 550 or 650? If cash is legitimately a 615, then you could make the case that September is going to get the bids because it's a discount to cash and you'll have interest to EFP that would. But, do you belong at 650 or 550? Kind of rolling into these spreads, Mike, for me, all that matters is the last CFTC report, commodity funds added to their short position. We know, or we think we know anyway, that they have this massive concentration of shorts that's still heavily skewed towards September. Between now and a month end, they're either going to have to liquidate or move the September into November. So this spread is already out to 10 over. It's 1090 last. It made a new high today. And I don't even think that you've seen really the fun roll start to take place. My guess is it's tomorrow into the end of this week, beginning of next week. So, the potential on this spread is going back to the $30 area and potentially even going out to the $45 to $50 area, knowing that those funds are going to roll between now and a month end. And if I'm going to use July kind of as an example here, you can see you got into the end of June, that spread traded out to 45 over. If I go back to this exact time frame, the spread was somewhere in the $8 to $10 area. So this is kind of a good indicator based upon this fund short position of what likely lies ahead. Again, I don't know. This is the one thing I want to stress. We don't know. The funds are going to short cover. The reality is, again, this is my guess, my opinion. I think they roll. I think the fund short position is a big macro aggregate short position where they're going to roll 90% of their shorts from September into November. So for this spread to get pushed out, you're either going to do it on September strength or November weakness. I don't know which one, but if September is going to go higher, then it should outpace November to the upside. If September is going to go lower, then November should outpace it to the downside to blow the spread apart.
Well, and what I'm looking at, when you look at each of the individual outrights, um, we're in the middle. It could it could actually go out like you said on both September strength and November weakness.
Yeah, yeah. And that's kind of, whether lumber belongs at 650 or 550 or somewhere in between. All I'm willing to say is that September to the downside should hold in better to November, and on the upside, it should have better upside rally potential than November. And I see that Matt asked, isn't SEP prone? Matt Lehman just asked, isn't SEP prone to upside surprises? The answer is yeah. That SEP NOPE spread historically goes off in that 10 to 15 over area. And seasonally speaking, you have a tendency to rally into the end of August, into September expiration before you settle down for the seasonal attack on lower lows into October, November.
And I mean, the other thing to know is this is vacation time for the financial markets. So the spread might move a little quicker or earlier than we had anticipated, um, because there's traders that aren't going to be at their desks.
Yeah, and the one thing I want to, Matt just said, that the entire world is telling us the sky is falling elsewhere, and I agree. Like every housing headline you see is negative, and that seems to be, the public sentiment out there. And when you look at today, this is lumber up here, this is SEP Nov, this is SEP, this is Nov. Well, why is the market up? I think the expectation was we had a negative housing starts number, negative permit number, and yet the market is up. Well, pure and simple, you probably didn't have fund selling today, and that's been the catalyst to drive this lower. I think the industry is reluctant to sell futures at a discount to cash right now. And if the funds don't come in and pound this thing, then you can have this void back to the upside like you're seeing today so far, where the market surprises, it hangs in there, even with the quiet cash market today, where you just don't have that speculative selling. And if the funds stop selling, then it becomes easier to get those rallies like we saw last week, where you can have a reset on the stochastics, that kind of stuff, where you get those oversold conditions with the funds. The second they stop selling, the market gets these bounce backs. And then I'll let me get rid of this. Um, when we fast forward here to basis, we've basically had convergence here between cash and futures last week into this week. Print legitimately is somewhere in this, let's call it, mills are really a 614 firm on 2x4s. Futures, obviously, September is traded as high as the 637 area. So as September starts to pull back, gets to too big of a discount, you get guys buying, people buying because it's too cheap. I'll buy September and look to EFP it. And so when you look at the basis, here's last week, that basis was $36. This week, it's basically an $11. This is saying cash is an $11 premium to September. So that's, the other reason why you're not getting the selling in September, because September theoretically is at a discount to physical cash right now. When you look at, here's November, and then the one thing, we'll jump into open interest and the CFTC numbers. Open interest actually, this is as of last Monday, 2754, down 2380. So the way I would explain this, so we talked about this convergence in basis here with the rally in futures up into cash. So when we go back to the September chart, commercials were actively, we talked about the CFTC numbers, Mike, last week, how they were a reflection of that move down to 520. So lumber sold off to 470. You had the funds chase this down to 470. You had commercials buy sub 520 all the way down to 470. When you had this bounce back, snapback rally in futures, you had the move back to convergence. So commercial longs immediately took the money out of their long futures here and just went and bought the physical cash. And then the flip side of that is you stopped out probably some of the weak-handed funds or some of the momentum type sells in the market that sold down to 470. So when we go back to open interest, yeah, we're down, but that's to be expected when you have a big bounce off the lows like that. And then this is the CFTC numbers as of August 9th. So this is as of last Tuesday. Look, managed money shorts increased another 314
That's
contracts.
amazing.
Yeah. And then you actually had some managed money longs chase that momentum to the upside. And then again, this is as of last Tuesday. So that's kind of prior to that big bubble to the upside. Okay.
Well, look, here's the number on here that is unbelievable. The short in the commercials, the producer merchant, 247. There's nobody hedged.
No,
There's
no. And
no, the industry is absolutely unhedged.
and so this tells me the industry not being hedged, pure and simple. It's the hope at higher strategy in cash and futures. If this was a big number, it would give more comfort that you had staying power to kind of withstand moves lower. But this not being a big number tells me the industry, specifically sawmills, are hoping this market higher.
So, Greg, what's the average number of EFPs that get done?
We're somewhere, let me see, it's somewhere, it fluctuates between 220 to about 270.
Okay. So let's just say we do 270. It's not possible. There's not 270 shorts in the hands of the sawmills if we were going to do those today.
Well, what this tells you is that, if the sawmills are going to EFP, then they probably still need to sell September somehow, some way. To what extent, we'll find out. And when you see this big build in the longs here, commercials, and rightfully so, okay, you didn't want to be short going into $470 lumber, but it'll be interesting to see, did this go up at all on this recent rally up to 630 in September and November? Because again, this is 1 week lagging, and we'll see how much this got reduced. My guess is when we look at this a week from today, Mike, you're going to see this number go down. This number, I have no idea. Ideally, you see this number move higher, this number move lower. Those should be this producer. Commercial long should decrease, commercial short should increase, and this managed money component should be down. Just looking at David Stalcup.
Yeah, I wanted to comment on that as well.
Yeah, referenced about the West Fraser curtailment announcement. To me, it has less to do with cost. It has everything to do with accessibility to logs in BC. And that's going to be more of the determining factor, where when you have all these profitable quarters back to back to back, having a month or 2 months of losing money below your break even of 600 or 550, whatever it is, I think you have the cash reserves to withstand that, and you're just trying to gain market share. For somebody like a West Fraser or some of the other mills, and I do think that there are at least 2 or 3 more curtailment announcements coming in the next couple of months to the next 6 months, next year. But I think it has everything to do with allowable cut First Nations and availability, accessibility to building out log decks. And in those areas where they don't think that they can build out their log decks at a profitable level, those are the areas that you're going to see those permanent shutdowns. It's going to be all BC, concentrated in BC. And you will see, again, the shift of production out of BC, continuation of that theme into the US South and everywhere else.
And I think the structure of the new futures contract didn't help these numbers for the short commercial side. Knowing that this was going to come up, they just didn't want to deal with it. My guess is that if we get some sort of rally here, you will see the commercials step in into that November contract. We'll let September, they'll let September go off the board, but the commercials will step into that November and, definitely start hedging up a little more of their production, especially when you look at other regions that have potentially lower log costs.
Yeah, no, and the other thing, and I know Matt will talk about this later this week, but I'm interested. It's pretty interesting when you look at Random Lengths print on just a 2x4 basis. The fact that Southern Yellow Pine is carrying a premium pretty much to all other species. Where, again, the one bullish thing for SPF here is that it's probably the cheapest species outside of Doug fir. And Southern Yellow Pine is probably the most expensive species right now. And typically that Southern Yellow Pine should be at a discount. So it'll be interesting to see. Love to get Matt's opinion later this week, just on when that reverts, where Southern Yellow Pine becomes the leader to the downside again and goes to a discount to the other species.
Well, we do know that down in the South, they keep building mills and fixing mills up, and they've got a hell of a fiber base. So it's probably going to happen sooner than we anticipate.
Yeah. Yep. And no, I just think, and Brian McFarland just kind of referenced who in the right mind is long cash right now. And that's part of the issue. I don't think there's any type of inventory build out here. I think it's going to be just in time. As the business materializes, we'll come into the physical cash market, but it's going to be past the hot potato as far as risk is concerned. And you take the risk. I'll pay you for it when I need the wood, but you assume the risk through ownership. And I'm not going to build out inventory this time of the year, and rightfully so. So I think the dog days of summer, this grind. I think you could kind of grind back and forth there more so than this big cathartic move to the upside or downside. I think it's, for that to happen, that's going to be a function of just outright fund liquidation. I think if the funds are going to roll their position, then you're just going to, on any given day, is it easier for the market to go higher or lower to push that spread out? And that'll kind of be the catalyst. Those spread rolls, once the funds start to roll, that'll be the catalyst on any given day to attempt to push that spread out.
Sean Hagens just asked, how's that new truckload contract going? One of the things that we're going to cover moving forward here is the spread between the old and the new. There's not much to hang our hat on yet, as Greg pointed out earlier. But, from what I'm seeing, the price band right now is to the high side, about 110 over. People are willing to sell the new contract, buy the old contract when the new contract is 110 over. Yeah. And it appears, it's like 85 to the downside. I don't have a good feel for the downside yet, but it looks like it's around 85.
Yeah, it's like around 81 to 85. You can see right now that September conversion is 75 at 122, and then the November is 71 at 110. Not trading or not reflected as trading, but again, I don't know how accurate this is because, again, on this system that I'm showing this on right now, I can't trade it, so I don't know how accurate. If I can't trade it, then it might not be showing trades.
No, those are the correct numbers.
Okay.
I know I traded a 110 in the November 2 weeks ago, last week maybe. Yeah, it must have been last week. So that was out there. I don't think anything's really traded on the buy side. So I don't know that we've actually seen someone hit a bid in there yet. But this is going to be really interesting to see where that fair value lands. It's going to be somewhere between 80 and 110, which, you take the halfway point of 95. That's about freight cost, isn't it? From BC to, Prince George down to Chicago.
Yeah. And I think, again, that's the to each his own, and that, again, in theory, the new contract's not a SPF contract. It's an SPF, hem fir, Doug fir, and to each his own as far as what they think their freight is to Chicago, and the willingness to deliver. But that's the one thing we need producers, and it's not for a lack of effort on my part, on Alex's part. We need new producers to come in and establish EFP programs. So Sean, Brian, Kyle, beat up the mills and tell them to get with it and develop
Yeah.
ESP programs.
And shameless plug for Greg, he will hold your hand and
Yeah,
walk you
yeah,
through the
no.
process and
But
help you
all
out.
it's going to take is one or two big guys that currently don't use it to embrace it, and I think you get the domino effect. But it's just going to take time.
Absolutely. All right. Well, so, just to kind of wrap things up, as far as where the prices are in the big picture of the contract, we're kind of in the middle of the range. Not surprising this time of year. The big surprise, the big takeaway I have is this continuing build of short position in the funds and the outright no short position by the producers. So, in my opinion, those things are going to balance out eventually here.
Yeah, and in a perfect scenario, you would get a rally, and then you would see this number shift over here. But again, that's the hope at higher strategy, and hope's
And
as we all know, trading lumber, hope's a terrible strategy.
and the powder keg issue is that spread, that SEPNOV spread. I can assure you that the 1,383 shorts will not go off short. They don't. They cannot deliver. So something's going to happen to those shorts. They're going to either roll or get covered.
Yeah, I agree, Mike. I agree.
So, all right, we'll see everybody next Tuesday. Until then, safe trading. Any questions, reach out to Greg or myself. We'd be more than happy to answer.
Mike, before I forget, I'm just curious if you either contact Mike or myself, but just everybody that can trade the new contract, I'm just curious, do you see it on your existing trade platform? It does. I don't, is it, DTN, CQG Trader, TT, whatever you trade, can you see and can you physically trade the mini contracts outright, the mini spreads and the conversion spreads? That information, if somebody, just drop either Mike or myself an email, because we need to let the CME know ASAP so they can get this infrastructure built out as soon as possible.
So, all right, everybody, we're signing off. We'll see you next week. Have a great summer week, and see you later.
Thanks, Mike. Thanks, everybody. Take care. Bye.